What's going on, everyone? Welcome back to Epic University. This is Brady Clark coming to you guys. And in this section, we're going to be going over Fibonacci and in more specific Fibonacci retracements, the way that I use them and the way that I implement them into my own personal trading setups. I've got just like any other form of technical analysis and markups, there's different ways to approach it and different ways to go about using Fibonacci. Even for myself, I've got a few different ways that I could use Fibonacci. But I do have one main approach and one main strategy with it that I follow for probably about 75 to 80% of my own personal trades. And so I'm going to share that with you guys in today's section. So typically the way that somebody would use a Fibonacci retracement would be, say, for example, just to put it onto the chart, all you have to do is come over to the toolbar here on the left side. If you go to the third one down, first it'll show up as the pitchfork. You just click that little out arrow, Fib retracement. And so there's a few different ways that people would use Fibonacci. One way would be dragging from a significant high to a significant low, and then using the Fibonacci to, enter and exit trades as price climbs up through the Fibonacci levels. Each one of these Fibonacci levels, they're key numbers, right? I call them PRZs. PRZ stands for a price reversal zone, right? Because when price approaches it, it can either have a big reversal or it can break through and explode through, right? So that's one way that people would typically use Fibonacci, is just dragging from a significant high to a significant low and using the Fibonacci points as entries and exits. Okay, another technique and way that people would use Fibonacci for retracements would be dragging from the significant high or low and using the Fibonacci levels to be able to get into another sell up here after this retracement back to the upside. Okay, and that's kind of the way that I use Fibonacci, but in a very specific manner. I'm going to show you exactly what I mean. The way that I use Fibonacci, the way I implement it, it's pretty simple. It's pretty straight to the point, and you guys are going to see exactly what I mean. Okay, so anytime that I am looking for a Fibonacci entry, I'm always looking for a break of a high or low and some sort of retracement to take place. Okay, one example of this would be if we had a consolidation zone. Okay, and then price comes and breaks past these two even highs. As soon as the market begins to retrace back down, that is when I would use my Fibonacci to be able to measure how far is this price going to push down before it hits its reversal point and makes its way to the upside. Okay, or vice versa, if we had an area of consolidation, right, and a break to the downside. As soon as that break happens and price starts moving back up in this retracement, that's when I would use my Fibonacci, right, from our most recent highs into these newly established lows to be able to see how far is this price going to climb up before it hits its ceiling, rolls over, and continues to the downside. Okay, so consolidation breakouts are the main time when I'm using Fibonacci in this manner. And another will be trend continuations. So if we have an uptrend, for example, how do we recognize an uptrend? It makes higher highs and higher lows. Okay, as soon as I see, so we're going into an uptrend, right? As soon as I see this most previous high taken out in order to continue this trend, and I see price come up and begin to retrace back to the downside, just like when price broke out to the upside of this consolidation channel, it's going to be the exact same scenario, right? As soon as price begins to retrace back to the downside, I would use the most recently established lows to the new highs, same thing, to be able to see how far this price pulls back before it turns around and makes its way to the upside. And as you guys guessed, if we flipped this around for the downtrend, it would be the exact same scenario, right? Dragging from our most recent highs down to our newly established lows to be able to see where price is going to come up here before it turns around and floats back and fulfills to the downside. Okay, so that's pretty much the general way that I find the setups with Fibonacci, right? I said about 75 to 80% of my trades I use this in, so not every time, not every single one of my entries is going to have a nice clean retracement like this, right? But a good chunk of them do. And so Fibs, just like any other form of technical analysis, any other form of markups, it's not something that you should ever use just on its own, right? You always want other confluences to go into your trade, right? If there's no confluence, there should be no trade. And so you always want to use Fibonacci retracements in this manner, but with other confluences as well to increase the probabilities of that trade, right? Just like supply and demand, trend lines, anything like that. Okay, so now if we have a breakout, and this breakout here, for example, have this consolidation, even highs, even lows, and the market breaks out, once it begins to retrace back, I have main areas that I look for that reversal to take place. The main Fibonacci levels are the 786, the 618, and the 50. Let me just flip this back around normally because it was a breakout to the downside here. Market retraces back up. The main levels I look for the market to come up to before it starts coming back down are the 50, the 618, and the 786. Right? So for example, right here, market breaks out to the upside, begins retracing back up. So I want to use my Fibonacci to be able to see how far is this going to come back down before it springboards to the upside. It's going to bounce off one of my levels, the 50, the 618, or the 786, in order for it to be a valid Fibonacci entry for myself. Okay, we drag from the most recent lows that it established before the breakout, right? Since it broke out to the upside, we're dragging from the lows first, up to the new highs it created before this retracement happened, right? Because we wouldn't be able to see any of, we wouldn't be able to see any of this up move yet. You know what I mean? We would just be looking at this market coming down into either the 50, the 618, or the 786, right? So you're always looking to take a bounce trade off of the 786, the 618, or the 50, no matter the setup, right? Now, the question is, how can you figure out or decipher which one of the fib levels it's going to be, the 50, the 618, or the 786? Let's bring this into a live market example here. Okay, a live market example. Okay, here's a perfect example. Perfect example. Breakout to the upside, breaks downward momentum, okay, and the market retraced back. Okay, it retraced back, a wicked into the 786, closed just below the 618, and then we were off, right? We skyrocketed from there about 221 pips. Okay, so that would be one live market example right there. I'm just gonna show a few more just to get your mind understanding it, and then I'll show you how we actually decipher the entry points. Okay, right here, right? Market breaks out to the downside, takes out these lows, comes down, hits the floor, begins to move back up. Remember, we wouldn't be able to see any of this yet. So we would drag from these most previously set highs before the breakout to those new lows right there and across. And then we see price comes back in, bounces off the 618 through the 50 and down. Immediately scores about 66 pips and then eventually into 121 pips down here. Okay, so you can see how effective this can be, but how can you actually figure out if it's stopping at the 618 or if it's going to keep pushing to the 786? Or if it's even stopping at the 786, or if it's going to keep pushing even further. Okay, what we want to look for is whatever time frame we've drawn this Fibonacci retracement out on. Say we see price come up and we think that it's bouncing off the 618. In order to confirm that it is rejecting off that level and making its way back down, we need the candle closure to close below the next Fibonacci level, which would be the 50 level. Okay, if price came up and rejected off the 786, then in order to confirm that it's rejecting that 786 and making its way back down, we would need the candles to come back down below the 618 and the candle to close below the 618 on whatever time frame you drew it on. So right now, I drew this Fibonacci out on the 4-hour time frame. So after we had this rejection of the 618, I would have needed to wait until this candle closed below the 50 in order to enter sells to the downside. Okay, if we go back over to our live market examples up here, or the drawn out examples up here, it's the exact same situation, right? We came Price came down here for the retracement, breach a little bit below the 50, so we technically rejected off the 618, and we would have needed price to close back above that 50 before we could even consider getting into a buy position to the upside. Okay, same thing over here. Price broke out of these even lows to the downside, retraced back up. It got wicked rejection off the 618, and I would have needed price to come back down below the 50 and close below the 50 before I could even consider selling opportunities to the downside. Same thing with the trend continuation, right? Price comes in, rejects from the 786 area. We would have needed a closure above the 618 here on the 4 hour before we could even consider buy entries. Okay, so now here's a little quick one right here. A little bit more of a longer scale one, but price came up, wicked into the 50. What would we have needed to see in order to know that this was actually a rejection off the 50 into the continuation of the downside? We would have needed to wait and for the candles to close below the 382 on the 4 hour here, right? Because the candles need to close below the next Fibonacci level on whatever time frame you drew the Fibonacci on. Okay, that's always how it's going to be. Now, if we're taking our entries off the 50 or the 618 or the 786, where could our general target points be? The main target points we use, or the main target points that I follow when I'm using, Fibonacci as a guide, is I have take profit 1 sitting at the 23.6. I have the take profit 2 sitting at the 0. And then if I push for a take profit 3 or 4, it'll be at the negative 0.27 and the negative 0.618. Okay, but the main ones I would go for are take profit 1 at the 23.6, right? Or take profit 2 down to the 0 point line, right? So if we took this, we waited, saw 50 was rejected. All right, we're waiting for the candles to close below the 382. We got candle closures below the 382. That would have been 175 pips take profit into TP2. Okay, but remember, always remember, you can't just be using Fibonacci retracements on their own, right? They have to be used with confluence of other technical factors. Okay, let me just clear everything off here. I'm going to jump onto Gbp Jpy real briefly and really just show you a few quick examples of this. Gbp Jpy is another pair that I really enjoy, especially with the Fibonacci. So right here we saw market structures broken up to the upside. So where would we drag from? Since we broke to the upside, we need to drag from the most recent lows that were established before we broke out. All right, we're looking at where we broke from to where we broke to. Where we broke from, the most recent low, up to the highs we made. Market came rushing back. So there would have been two opportunities in here, right? Because the main one that I was looking at was right here when we rejected up the 618. But technically even before that, right? Before that, we rejected off the 50 and had a closure above the 382. And then we temporarily pushed in to take profit 2 for about 90 pips or so. Then the market pushed back again, even further into the 618. Pushed away. We had the closure above the 50 because that's the next fib level up. And we could have taken our buys into take profit 1, take profit 2, and potentially even further. All right, guys, so I hope this makes sense to you. Head on to TradingView. See if you can find yourself a few Fibonacci retracement entries, right? Remember, what we're always looking for is when we see market structure broken, right? So highs or lows taken out, when we see trend continuation, and when the market begins to retrace after that happens. Okay, that's what we're always looking for these Fibonacci entries. Right here, there was a little one. Not as clean of a market structure break, but we still took out these lows and these lows. That high, all this market structure through here. We took that out to the downside and market began to retrace up. We take that from the most recent highs we established since it broke out to the downside down to these new lows that were established and across. Market came up, wick rejected off the 786 and down. Okay, and one quick point to note is that my 786 level is the very furthest point that I'll allow. Meaning if we push back past the 786 point and we start closing up there, getting some candle movement, I'll no longer consider that a nice retracement. Like I won't consider that a valid Fibonacci retracement anymore. Because a lot of the times, once we break past the 786, a good chunk of the time we keep pushing into the 1 and back and back and back, right? And so 786 is kind of just my furthest line possible that I allow. If we get rejections off the 786 and a closure below the 618, I'll open the mindset to sell opportunities. But as soon as that market pushes above that 786, I no longer consider that a good retracement, and the probabilities of it coming back down have decreased a lot. So the 50, the 618, and the 786 are our main retracement areas. After we have the bounce of one of those levels, remember, in order to confirm that it's actually rejecting it, we need a candle closure below the next Fibonacci level on whatever time frame you drew it on. Okay, so head on to TradingView, guys, apply this, try to find some Fibonacci retracement setups so that you can really understand it. And yeah, it's super effective. I use it, like I said, for about 75 to 80% of my entries, with other confluences, of course, but it's highly effective. So master it, guys, get it down pat, and it'll really bring your trading to the next level. With that being said, we will see you in the next section. Have a great day, everyone.